Right, guys, now let's finish up with the last example on IAS 8, but actually this time around we'll deal with prior period errors. The question will be centered on prior period errors. Now, as usual, the beginning of the question will be asked questions that are actually explained in the notes. You can just refer to the notes here, defining accounting policy, difference between accounting policy and accounting estimate. We have spoken about this all. Outline the accounting treatment required to record a change in accounting policy, a change in accounting estimates, correction of error, things like this. All right. Now let's go to this question. This is our main point here. The main point. Don't worry about other questions I could be asking you in the group. So the question says, the following are summaries of draft financial statements of Sigma PLC for the year ended 31st July 2015, together with the comparative figures for 2014. So I just given the financial statements here. And then we're told, during August 2015, you know, the financial statements end at 31st July. Yeah? During August 2015, that means actually August 2015, prior to the signing off of the financial statements, it was discovered that a fraud had been taking place in the company for the previous 3 years. So fraud was discovered. Oh, that's why I told you when dealing this standard, you have to check whether it's an accounting estimate, policy, or error, or a prior period error has occurred. You have to ascertain that, is it a change in accounting policy? I'm repeating again, a change in accounting estimate or a prior period error. Now, this is pretty much obvious. This was an error. An error would not mean just the human, someone didn't want. No, something was done that shouldn't have been done, obviously. Not because you have changed the policy. No, it just shouldn't have been done for no reason of change of policies. It just happened. And this was August. You know, the financial statements, these are for the year 2015. So the year ends 31st July. But when the year ends 31st July 2015, if this is the reporting date, it is not necessary that the financial statements would be complete. The financial statements would probably not have been issued, not have been authorized for issue. Before the financial statements are signed, they can be adjusted. Now we are told that prior to the signing off of the financial statement, it was discovered that fraud had been taking place. Fraud truly indicates a prior period error. So you get your gears up, you get the picture. Oh, so speaking of prior period errors, you get the picture that, oh, we'll have to check to make retrospective adjustments. So you go further. The chief financial officer had been misappropriating monies paid to the company by its customers. The amounts instead appearing as receivables. You know, when you sell something to a customer, maybe goods, you debit trade receivables and actually you credit sales. So those receivables, when a customer pays you, you credit those receivables and you debit cash. Now this chief financial officer actually was maneuvering something. Instead of receiving cash and writing off receivables to record cash, he was pretending as if he had received nothing. All right, where did he take such amount of money? Let's proceed. The effect of the fraud was that amount shown in the statement, in the financial statements as receivables, need to be written off as they were in fact paid. The amounts were in fact paid, but the guy actually misappropriated the monies. So we say there is no prospect of receiving the money and the employee lost it gambling. Meridian Bet, Premier Bet, and is now bankrupt. So the guy took the money and he took such amount of money to betting shops, maybe and to gamble in the casinos, and this is what happened. So actually, you ask yourself, if he had the money, we would have credited receivables and we would have had to debit cash, isn't it? Before going any further, before doing anything, you have to apply the fundamental principles that you know. Before going to this standard, this is just a standard, but you have your fundamental principles with you. Receivables is an asset, it has a debit nature. And now we know that it was paid, so we have to write it off. So it's obvious that I would credit receivables just like this, but we are just asking ourselves, what will you debit? If we realize this, we would have gone to the chief financial officer and took the money from him. But let's say he doesn't have any money. If he had the money, we would have taken cash actually by force and he would have debited cash. But he doesn't have money. He's bankrupt. So if he's bankrupt, you have to write off the trade receivables and take them as bad debts. Am I wrong? This is what should have been done. You get this picture and then you go deeper into the question now. So this is what should have been done. Bad debts, so you write off trade receivables, you write off receivables, but also you go and expense them in the statement of profit or loss as bad debts. So let's finish up with the question. After reaching the question, to be just simple, just taking a very short time. So here we go. The amounts were as follows for each period ending on the following dates. Now, for the year ending 31st July 2013, he took 14 million. 30 July 2014, 16 million, and 31st July 2015, 20 million. So this is what was happening for 3 years. The guy had really taken the money and he was still writing them as receivables. All right, so we are just told, so these were the financial statements. Statement of profit or loss for the year 2015, as well as, now you see here, you have been given the financial statement for 2015 and 2014. We are also provided with statement of changes in equity that has retained earnings. Our main goal is to deal with retained earnings. That's why they have written retained earnings only. Do you see this? I hope you do. So as you know, the statement of changes in equity, usual right opening balance, you take the profit for the year, because profit for the year is an adjustment to retained earnings. Dividends are actually subtracted from retained earnings, so we subtract dividends and we obtain the balancing figure. But this is when the financial statements have not been corrected, and this is a statement of financial position, just like this. Now, what are we required to do? Don't be afraid of a question like this. This is a very, very simple question, much straightforward than even the above ones. So you're told, restate the above financial statements, including comparatives, incorporating adjustments you deem necessary as a result of fraud. Ignore the effect of taxation, and disclosure notes are not required. You know, in case there was tax, you would have to account for tax. There is a question incorporating tax, actually. So let's go to the solution. The solution would have been this way. They just want us to adjust everything. First of all, we need to adjust the statement of profit or loss. This is very simple. The statement of profit or loss is for this year, right? This is 2015. So for 2015, we'll make an adjustment relating to this year, 2015. For 2014, we'll make an adjustment relating to 2014 because the income statement is based for just 1 year. Understand this. The income statement is for 1 year, but when you go to the statement of financial position, assets, equities, those are accumulations. So you have to accumulate there. So let's just go to our scenario. This was our scenario. This is 2013. It has nothing to do with 2014 and 2015 financial statements in the statement of profit or loss, because as per statement of profit or loss, we just have 2014 and 2015. So we'll just come to 2014 here. This was what happened. So if this is something that happened, as I told you, you have to credit receivables. So you go to statement of financial position, you credit such receivables, and you debit bad debts. Bad debt is an expense. So in 2014, there will be an expense of 16 million, but in 2015, there will be an expense of 20 million. Just like that. You just have to remember that when you do this, you do a double entry. So you charge the expense instead profit or loss. You have to know that you would also have charged what? You would also have decreased the asset. There is that receivable by 16 million. So you have 16 million and 20 million for the statement of profit or loss. Let's just go and do this and be done with the statement of profit or loss. So you copy revenue as it is. You just copy revenue as it is. Cost of sales, just copy them as they are. But when you come, you would have the gross profit just as the difference is normal. But when you come to expenses, let's go back here and see the expenses, the figures. These are the figures for expenses, right? Expense here was 30 million and this was 26 million. So you just go and add these figures. Actually, you could write bad dates, but they are just written expenses, so no issue. You could just adjust here. In course, it was an adjustment on inventory. Inventory stays on cost of sales. You could have put it here, but now you put it under expenses. So expenses, 2014 add 16 million, 2015 add 20 million. And you come and get something like this here. See, expenses, you take 30 plus 20 million, and you have your 50 million here. Then you take 26 plus 16 million, and you have 42 million. And then you subtract and you arrive at the new profit for the year. You are done. So when correcting the statement of profit or loss, even if you're not told, it's very simple. Simply speaking, when correcting profit for the year, it's like if you are not asked to prepare the statement of profit or loss, you would have just come to statement of changes in equity here and adjust this profit for the year. You see? Now look, you see, this profit for the year would change. This one would change to 25 and 21 as you have obtained them under statement of changes in equity. This one, 25, and here 21, instead of the previous profits. Now we are done with the income statement. Let's just finish up on statement of changes in equity as well as statement of financial position. So let's go to the statement of changes in equity. Now, what about the statement of changes in equity? We have already made the difference, the adjustments on profit. So profit for the year has got no issue. We are done with this. Let's just go to the balance on 1st August. The balance on 1st August is just simple. We said that we apply this retrospectively. By applying it retrospectively is we adjust everything in the past. Everything that happened in the past, we have to adjust. So it's just very simple. Just ask yourself, this is 1st August 20, as for 2015, we say that this is 1st August 2015. So take everything before 1st August 2015. And you know, the double entry was to reduce assets and to debit expenses. Expenses goes and reduces profits. If profit is reduced, retained in earnings are also reduced. So just go and accumulate all expenses that should have been subtracted but not up to this date, 1st August 2015. Now go to the question. 1st August 2015. This one was 2013, so you have to include it. It was before 31st July, before 31st July 2015 too. We are talking of 1st August 2015. 1st August 2015, right? If I'm not wrong. So for 1st August 2015, we would have to take all these 14 million, 16 million, as well as 20 million, giving you a total of 14 million plus 16 million is 30 million, plus 20 million, it's 50 million. So if you come to the question here, you would have to adjust this figure by 50. Let's just go and take a look. This was what? Oh, we have to, let's just go and check. I think I've cross-checked something. Oh, this was 2015 and this is 2014. I think I reversed something here. Let's just take a look properly here. It's like, yeah. Oh, we didn't read proper. This year ends at 31st July, right? It ends 31st July 2015. And this is the balancing figure. This is the balance on 1st August. Right. So this is the balance on 1st August 2015, but this is the balance on 1st August 2013. So before let's start with this. Before August 2014, that means it's 31st July 2014 going back. So let's look for 31st July 2014 going back. 31st July 2014 going back. 31st July 2014, it's here going back, but going back. So you would have to reach and have this figure. This is 14 million, right? So you would come here, well, statements, put 2014. Wow. I don't see this. Here, this is 2014. You would come and subtract this 14 million here, right? Yes. And then let's go for 2015. 2015, what would we have done? You know what? The year ending 31st July 2014 starts at 1st August 2013, right? The year ending 31st July 2014 starts at that. We have about 8 minutes. The year ending 31st July 2014 starts at 1st August 2013. So we have used this 14 because actually we have to take the figures before 1st August 2013. And the figures before 1st August 2013 are here, you know, this one. 1st August 2013, this is the only figure before 1st August 2013, so that's why you use 14 million. But as for 2015, if you come to 2015, the year ending 31st July 2015, that means it is started on 1st August 2014. So the opening balance is on 1st August 2014. So to take everything before 1st August 2014. If you come here, it would only be this 2015 and this 31st July 2014. Because this one would be in the true period. So you take 14 million plus 16 million, giving you a total of 30 million. So the retained earnings adjustments for the other year, for the remaining year of 2015 would be 30, this one. That's why you call this prior period adjustment. So you would adjust here. Then after this, you would have the restated opening balance. That means 258 minus 30, and here 236 minus 14, ending up with the restated opening balance of 228 as well as 222. And after here, you would have the profit for the year. You would have your dividends declared and have the new balance, which is like this. This would be the end, and so you have just remained with the statement of financial position. That is just about copying. It got nothing much. You know, the statement of financial position, the receivables have to be affected, right? We are just given non-current assets. We are given net current assets here. And also we are given equity share capital and retained earnings. So as for retained earnings, we have already recomputed as 237 and 228, right? We got them in the statement of changes in equity here, 237 and 228, so no issue. So the only remaining entry would be on receivables. So if the company was selling something, these receivables would be under current assets. But here we are just given net current asset. That means current assets minus current liabilities. So the adjustment would need to be performed under these figures here. How did you get this 93 and this 72? Because initially these are not the figures that we had. Look, we initially had these figures. We are just finalizing here. We had net current assets of 143 and 102, but they just changed. How would they change? It's just easy. If you deal with the statement of financial position, look at the date under consideration and go back at just all the remaining past transactions that were wrongly recorded, just like this. So ask yourself, this is 2015 and these assets are 143. So go take all years before 31st July 2015. I mean, take everything up to 31st July 2015, up to, this is the closing balance, so you go up to 31st July 2015. Up to 31st July 2015, actually, you would have this for 2013. You would come down here and have this for 2015 as well as this one for 2015. So you'd have 14 million, 16 million, which is 30 million, and 20 million, which is 50 million. So for 2015, I would have to adjust by 50 million. But what about for 31st July 2014? For 31st July 2014, I would have to use this one as well as this one, because this is the end of 31st July 2014. So this one wouldn't be used. So we'll take 14 million plus 16 million, giving you 30 million. So let's just finalize here, and I will have to tell you something. So you come here, these are net current assets. How did we arrive at this 93? We took 143 figure minus 50. And for 72, we took 102 minus 30 and arrived at the result. So this is what we did. So after that, you have to just add and get your equity here. And also have your other values here. So actually they would be the same. So it just depends on how you decided. For example, they decided to take assets minus liabilities to be equal to equity. So this is how we go about this. Thank you for being together. Actually, if you need any other thing, you could just be telling me. In case I have the time, I could prepare, but also could visit the YouTube channel to read on anything that you're interested in. Even if you have questions on investment appraisals, performance management, everything, you could just ask. And actually, we'll look for a way to settle that. So thank you very much.